Good morning, your average investor. Another fun one today. We're going to be talking about the interest rates and how Fed Governor Bowman explains that she has some concerns about the current rates and what they're doing for it. So earlier, she had said that she was dissented in the recent interest rate vote. She expressed concerns about elevated inflation levels, and she emphasizes the need for caution in current monetary policy. And so what we're learning here is she believes that inflation risks remain within the current economic cycle, despite signs of the stability that it is currently presenting. So advocates for a stricter approach to rates, they usually prevent entrenched inflation, which is great. However, Bowman's dissent indicates a belief that the current monetary policy may not be sufficiently addressing the continuous and ongoing inflation concerns that the country currently is going through. So when I was taking a look at this, there was an interesting quote that she backed future rate cuts, but at a measured pace. And further, from this article right here, she said that going slowly would also avoid unnecessary stoking demand. Higher demand, in turn, could foster higher inflation. So what do we think about this? Her stance suggests a need for continued vigilance to prevent inflation from becoming a long-term issue. There is some level of interest rate adjustments, and considering the increase of interest rates further to curb spending and borrowing, this might be an appropriate countermeasure. There was a few other ones that we did like, from just a general macroeconomic standpoint. Quantitative tightening, for instance, reducing the central bank's balance sheet to then decrease liquidity in the economy could be a helpful way to do it. Targeting fiscal policies, we sometimes see people implement fiscal measures that support supply side growth to ease these inflationary pressures. And then overall, there's some economic measures that can ease inflation, encouraging supply chain improvements. So investing in infrastructure and logistics to enhance production and distribution would be a nice long-term play. Will we get there? Not entirely sure. But what we do see from time to time is we see that you can do a support productivity growth by promoting innovation and technology within the United States. And this adoption or adaptation to key sectors will drastically increase the output without raising prices. Two other smaller ones that I can think of off the top of my head: you can monitor commodity prices by keeping essential goods and services down, which would then mitigate price volatility. And then you could address labor market constraints by implementing policies to help improve labor participation, increase skills or the labor skill force, which then helps meet the demand of current issues. So what does this mean for us? What does this mean for implications of the stock market and the investor? Market volatility. So increased interest rates or tightening of monetary policy can lead to short-term market volatility. Investors start adjusting their expectations. A lot of these groups have investment groups that need to adjust their thesis or their performance, and then this could also impact sector performance. So financial sector, some of these have potential benefits from a higher interest rate standpoint. Profit margins on loans may then thus improve. And you have some growth stocks, which growth stocks often face pressure as higher rates can increase the discount rate and reduce future earnings. So these growth stocks are going to start struggling. So overall, investment strategy, investors such as yourself, your average investor, they might want to shift towards value stocks for the time being, or sectors that are less sensitive to interest rate changes, such as utilities and consumer supplies or staples. We haven't seen too much of this, but this is something to pay attention to. And thus, when you think about these long-term instruments, bonds always come to mind. So rising rates could lead to a declining bond price. Those bonds can become less expensive, which would then prompt investors to reconsider, these whole fixed assets component of their portfolio. And so the last two things, in economic growth outlook, if inflation concerns lead to aggressive rate hikes, which we have seen continuously go through time by time, we want to make sure that we are not slowing economic growth too much. That can negatively impact long-term what's going to happen from a corporate earnings or an overall market standpoint and sentiment. So, we stress increased caution. Investors may want to adopt a more cautious investment approach, prioritizing dividend-paying stocks and defensive portions or positions of their portfolio in uncertain economic conditions. As we continue to see some of these, 2 full percentage points through next year is what they're proposing. Fed's benchmark overnight borrowing rate is now targeted at 4.75 to 5%. Things to consider when you're making long-term investments if you're not doing any of the fun day trading stuff and you're looking for, your average portfolio. Let us know in the comments what you think about the Fed rate. Let us know what you think about Bowman's decision here, what her outcry was when she made that comment, and what you guys think the overall market sentiment and the economic macro conditions are. Would love to hear it. Subscribe, help us monetize the channel. We'd love to give out some additional giveaways and help people out. Thanks again. Take care.